Hi everyone, Toby Johnston here, partner with Moss Adams in our Silicon Valley office and practice in our private client group. I'm excited to talk to you today about QSBS Baseball. But before we get to the good stuff, let me read our obligatory disclaimer. The material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice. This information is not intended to create, and receipt does not constitute a legal relationship, including but not limited to an accountant-client relationship. Although this information may have been prepared by professionals, it should not be used as a substitute for professional services. If legal, accounting, investment, or other professional advice is required, the services of a professional should be sought. Assurance, tax, and consulting offered through Moss Adams LLP, investment advisory offered through Moss Adams Wealth Advisors LLC. So now that we've gotten that out of the way, what is QSBS Baseball? Well, qualified small business stock has been around for nearly 30 years now. Came into the code back in 1993 as Section 1202, and for the first, let's say, the first 17 years or so, there wasn't a lot to it in terms of benefit. Some of the states had good benefits, but at the federal level, there just wasn't a strong incentive to try to do planning with Section 1202. But that all changed in 2010. The initial, well, the basic rules of qualified small business stock say that you get to exclude up to 50% of your gain upon sale of qualified small business stock. And it was in 2010, during the Great Recession, that Congress really sweetened the deal and they made that 50% go up to 100%, and not only excluding the capital gain for regular income tax purposes, but for alternative minimum tax purposes as well. And so for stock purchased in a domestic C corporation after September 27th, 2010, that's when you really start to get the good benefit. And so that's the first main requirement. There's four others that I'll briefly review. And by the way, there is a companion article that goes with this video that I would encourage you to read. There's a link to it at the end of the presentation, and there's a link within that article to even more information on qualified small business stocks, so we can get you nice and read up on that. But the second main requirement is that the stock needs to be in a qualifying industry. And so there are a number of industries that do not qualify, including financial services, energy related, production, farming, and hospitality. Active business requirement is the third test that of the general test that needs to be met for qualified small business stock. And an active business requirement basically says that at least 80% of the value of the corporation's assets must be used in the conduct of an active business. So this isn't a situation where you can purchase stock of a passive holding company or an inactive business. The fourth requirement is that you have to hold the stock for at least 5 years. The fifth requirement is that immediately after the issuance of this stock that you're buying, the corporation needs to have had less than 50 million of aggregate gross assets. And this requirement is commonly misunderstood. It does refer to book value of those assets and not the fair market value. And so even if the fair market value has really taken off, many times the book value of assets on the balance sheet is still going to be less than $50 million. And so what is a single with QSBS Baseball? Where do these benefits begin? Well, they begin by the ability to exclude up to $10 million of federal capital gains or 10 times your cost basis, whichever is greater. For most people, the $10 million is going to be greater since they put in the initial investment with when the company is not valued very highly, and so they don't have a lot of cost basis. But if you think about it, excluding up to $10 million of federal capital gains, that could save you about $2.4 million, and that includes 20% long-term capital gains tax and 3.8% net investment income tax. So that's how you get on base. You hit that single, you exclude those gains. But how can you go from first to second base? How could you get a double out of this? Well, a double would be to extend that benefit on that $10 million beyond yourself as the taxpayer. So the way small business stock works is that the limitations are at both the company level and at the individual taxpayer level. And so to the extent that you can gift your shares to another individual taxpayer or perhaps to an irrevocable trust, that's a different taxpayer, and that other taxpayer can get their own bite of the apple and get their own potential to get up to the $10 million gain exclusion. And so now you've gone from 2.4 million with yourself to another 2.4 million with a separate taxpayer. The main hurdle you need to clear there is that you have to go through the gift and estate tax rules to actually gift those shares to another party. And so you'll want to do that normally when the valuation of the company is lower so that you can make wise use of your lifetime gifting exemption. So how do you go from a double to a triple? Well, a triple is all about this potential for state tax benefits, and there are many states, most of them in fact, that conform to the federal rules, and you shouldn't have a problem with that. You'll be able to exclude the gain at the state level just like you do the federal, but one of the really important exceptions to that among the states is California. There's a handful of others as well, but let's focus on California for a minute, since a lot of investors taking small business stock benefits do live in California and they're investing in tech companies, perhaps in Silicon Valley. Well, California does not conform at all to the Section 1202 of the Internal Revenue Code, and so there is no state tax benefit. And so how could you get a state tax benefit? Well, it's about transitioning your residency out of California to either a tax-free state or to a state that does conform to the federal rules. And so there's sort of a way to do that smoothly and cleanly to avoid audit and to avoid pitfalls. And there's a way to kind of do it messily and likely get yourself audited and potentially be challenged and have to pay the tax to California anyway that you thought you were going to save. And so that is the way to save not only at the federal level, but at the state level, and that's what we call a triple. So the final point here is a home run. You can hit a home run with your qualified small business stock by taking advantage of the single, double, triple techniques, but then also doing what's called Section 1045 rollover method. Let's assume that you've already done these other things and you still have more qualifying small business stock. It's not as rare as you might think if you are a founder of a tech company, for example. So you've taken advantage of these other savings, you still have more stock available. If you were to sell some of that stock and roll it over under Section 1045 into another qualified small business, you can basically start the cycle all over again. And so that's with a strict reading of the code. There are some that think, you might be challenged by the IRS, and we've yet to see that, but these benefits for small business stock have not been around a super long time, so it's possible you could be challenged. But a clear reading of a strict reading of the code rather would say that doing this rollover method and holding and meeting all the requirements with the new company would start the cycle over again. And so we've rounded the bases now, and we're ready to play ball. But want to mention finally here that the importance of assembling the right team. You need to get the right players on the field to take advantage of all these benefits. And so I think that team is probably someone who kind of understands the big picture here. It's a team that can help qualify your shares at the company level. There's some pretty detailed requirements there, and it's not always clear cut. I think that team would also include estate and gift tax professionals to help you to navigate the gift tax rules of establishing another taxpayer to get these benefits. I think that team could include state and local tax professionals if you're a resident of California looking to move out and to take advantage of state benefits elsewhere. And just to wrap it all up, qualified small business stock has been around a while, but the opportunities are better now than ever, and we would encourage you to assemble the right team and seek out advice on how you can benefit from this code section. That's all for today. read the article and please contact myself if you have questions. Thank you.